Hey everyone, today we're going to talk about one that comes up all the time and probably one of the most common topics that I chat with clients about, particularly clients who are running their business out of a company. So if that's you, if you're running your business out of a company, this is one for you. And you've probably heard your accountant talk about taking money out of the company and the complications that arise when you do that, and this whole Division 7A problem that we like to harp on about. And it's for good reason too. It is something we've got to be careful of. We need to make a strategy to deal with this because it can really get out of hand if we don't do anything. So we're just going to should be a relatively quick video going through how this problem arises. I'm not going to go through all of the solutions in detail, but we're going to talk about the problem and a few things we can do about it year over year. It's often a reoccurring problem. It rarely just happens once. And so the first thing I want to do to explain this concept is we're going to use an example profit and loss of a company, and we're going to talk about retaining profits versus paying them out and what that actually means. And it's easy to get lost, so I think that the easiest way to think about this is just by imagining the profit and loss statement of our company. So here we've got FY25, so financial year 2025. We're just going to work down the profit and loss and see where we end up. So we've got sales, 800,000. Less our direct costs, we've got direct purchases or materials, and we've got some wages and super to our employees or our staff, okay? That's going to leave us a gross profit of 388,000. And then out of that comes out all of our operating costs. So advertising, bank fees, cleaning, insurance, motor vehicle, occupancy costs, that would cover rent and electricity, everything like that. Office costs, software, subscriptions, some training and travel. And this is just an example profit and loss, but you get the idea. You'd be pretty familiar with how this looks. And you've got your total operating costs here, and then our operating profit. That's what's left after all of our direct costs and all of our overheads. And I'm going to call that our operating profit. Out of that, we often would pay our directors or our owners a salary. Now, there's a few ways to get the profits out of the company. But right now we've got $350,000 worth of profit. And in this case, we're going to pay the director a wage of $190. They're also going to put their super in, and that comes to a total there. So we've got our profit minus what we pay to our director as a salary. That's going to leave $143,000 of retained profits in the company. And that means we haven't paid them out. They're still in the company, and we might want to do that because that company has a lower tax rate than our personal tax rate at this income level. And we're going to talk about tax rates in just a minute. What would happen next with our retained profits is the company would then pay tax at 25%, and that would get paid to the tax office, and we would be left with about $100,000 worth of cash in the company bank account. Now, if that's getting used for expanding the business, buying new plant and equipment, advertising, growing the business, that's fine. You really don't run into any problems. But where the problem arises always is that at the end of the year, we've got 100 grand in there, and the directors or the business owners, they want to do something with it, and they pull it out. They just take it out of the company account and they put it into their personal bank accounts, and maybe they're going on holidays or buying a car, or they might be using it as a deposit towards a property or anything like that. And what often happens, it'll just get spent on personal expenses, and maybe they'll take that out and put that in their personal bank account and then use it for personal use, or they, in a lot of cases, they'll actually just run the personal expenses through the business bank account or the business credit card, and at the end of the year, we look at that and we say, all right, there's a whole bunch of personal expenses there, and really that's the same as taking it out of the company. And so, just quick picture here, the trading company has earned a profit and it's retained it, and on the books it's the one paying the tax, but you, the director, have just taken the cash out, okay? Now, this is a problem. The best way to understand this problem is to think about tax rates, okay? And so, let's just look at this picture right here, and this is our personal income tax rates, or our marginal tax rates. And so they're called marginal rates because they go up as we earn more. So the first $18,000 that we earn, we don't pay any tax. For the next chunk, up to $45,000, we pay 16% tax. From 45 to 130, we pay 30% tax. And then up to 190, we pay 37% tax. Over 190, we're paying 45% tax. And again, just a reminder, we need to add on the 2% Medicare levy that goes on top of those tax rates. So for example, that top rate, it's actually 47%. And if we compare that to our company tax rate of 25%, you can see here there is a massive difference in tax rate. There's 22% difference in tax. If we're in that top bracket, the company is paying 25%, we're paying 47%. There is a 22% tax differential between the company and the personal tax rates. And so obviously you see a lot of situations where on paper we pay tax in the company, but then the director just takes the cash out. So they've saved 22% tax. They've saved that much in their mind. They've taken that, and they've got way more cash to go and spend and do whatever they want to do. Now, the tax office obviously doesn't like this because, for example, on $100,000, they have lost $22,000 worth of tax revenue. That's just, that's slipped through the cracks, okay? Now, before these laws were introduced, well before my time, these laws weren't in place. And it really wasn't a problem because back then, the corporate tax rate or the company tax rate was actually way higher. This has only become a problem over the last, probably over the last 20, 30 years. As the company tax rate has come down, it's now much lower than our marginal personal tax rates, once your income's at a certain level. And so they brought in these laws, and this is what we're always talking about, Division 7A. These are these laws that capture that missing 22%. Now I say 22% here just to make it obvious. It is a big amount when we're earning so much. But if we're only, if we're earning $100,000, for example, there's really not that much difference between our company tax rate and our personal tax rate. Our company rate, 25%. Our personal rate is 30%. But if you averaged out that personal rate, it would be low 20s, mid 20s for the first $100,000. So this really only becomes a big problem when we're earning, we're in these brackets here and this bracket here, and it is a big chunk there. So the tax office doesn't, you can just take the money out, but there are sort of, there are implications of doing that. And let's just think about, the ways we can deal with this problem. Okay, the first way is we just take a salary. We pay it out as a proper salary. We pay the super on that. And that's always a pretty good option up to a certain point. And again, that point is based on these tax rates. If you had $45,000, you just pay it out as a salary because then you're at a nice low personal tax rate, no problem. And even up to $100,000 or even $135,000, paying it out as a salary is a pretty good way to get the money out, because really the tax rate's pretty similar. But the problem happens is, once we get up to this territory here, you don't really want to be paying it all out because, as you know, you're paying a much higher tax rate. Another common situation, especially in the early years of a business, is just repaying the money you lent the business. So, if you've started a business, you probably had to put some cash into the company account to get things going and get things started. And also, if you've bought a business, you might have borrowed some money, but often you'll put a bit of cash in. And so let's just say you lent in $100,000 to get the business started. That $100,000 is basically a loan to the company that we can repay back to ourselves, over those early years. And so often in the initial years, you would be paying a bit of a salary to use up your low tax brackets, and then you would redraw the money you lent the company, and that would basically come out tax-free to you. But that only works if you've lent money into the company and you're then repaying it back. Not everyone's in that position. Some other people will sort of take it out and then put it back before the end of the year. And a common example where this happens is if you've got a home loan and you've got an offset account. So instead of money sitting in the company bank account, you might put that in your personal offset account, use it to save interest throughout the year, and then you're going to put it back into the company before the end of the year. You can sort of get away with that for a while, but it's not really a long-term strategy. You can't just keep moving money back and forth forever. At some point, you really need to get the money out and do something with it permanently. So you can sort of get away with this for a little while, but it's really not a long-term solution to anything. The other thing you can do is pay a dividend. And you can pay a franked dividend, which means that the company's paid tax, and then in year 2, you're paying that dividend out with franking credits. I will have another video on franking credits, so you can go and check that out. Again, nice, easy solution, especially if you have a trust being the shareholder and you've got some flexibility. But at the end of the day, it does come back to your personal tax rates. Okay, so whether it's a salary or a dividend, it's all going to contribute to that personal tax rate, and it's all fine and well while you're in those lower brackets. But it's when you start getting to a higher tax bracket that is really you start feeling the tax a bit more. Now, option 5 here, do nothing. This is what you can see a lot if you haven't had a good accountant looking after you, or if you're just sort of winging it on your own. This is the worst of all options because you just do nothing, right? You've taken the cash out into your personal name. You haven't done any of these things. And then the tax office catches you and they say, all right, well, you already paid the company tax, but it's not enough because there's this gap and we're just going to sting you the extra tax twice. So you're basically, in that case, that is the worst case, you're basically paying tax twice on the same amount of income. That is not where you want to be. And so another way to manage that, if we don't want to do any of these things, another way to manage it is to put in place a complying Division 7A loan agreement. I won't go into a lot of detail in this video on what that does, but it basically means we've borrowed the money and it is a loan and we do have to repay it, often within 7 years. You can extend that if it's a secured loan, so it's backed by property. You really never see that in practice. Very, very rarely. So often you would say, all right, we've borrowed this money out of the company and we're going to pay it back over the next 7 years with some interest, and the tax office tells us what that interest rate is, and it's often pretty high. I think it's currently up around 9%, 8 or 9%. So pretty high interest rate. That gets a bit confusing for a lot of taxpayers as well. Because often we don't repay it with cash, we repay it by issuing dividends or other strategies like that. I'm not going to go into that right now. The key thing here is that if we do nothing, there is a problem, and the tax office is going to come after this gap here to get their missing, their lost tax. Okay, so we have to do something. I will have another video going through the details of when this is a good idea, but just to give you an idea, this Division 7A loan agreement is a really good effective tool when we're using the funds for investment. If we've borrowed the money from the company and we're gonna use that to, you know, as a down payment on a rental property or you know, for shares or some other type of investment that produces income, this can be a really good strategy. It's a terrible strategy if we just take the money and we spend the money, because this sort of lets us stretch it out over a 7-year timeline instead of just paying everything in year one. But if you just, you know, you spend the money on vehicles or holidays, and you keep doing these loan agreements every year, you'll get to a point where you've taken out so much cash, you're repaying multiple years worth of tax at once, and you've just sort of pushed everything back and back and back until you reach breaking point where you're really in trouble. So again, I will only ever really talk to clients about this when they have excess profits that they're using for investment purposes. I hope this was a good overview, and I think the key thing to think about is this graph when we're trying to understand why this is a problem taking the cash out of the company. Get in touch if you'd like to talk about this and your business. Thank you.